The audit of accounting estimates poses unique challenges and risks for auditors due to the subjective nature of these estimates. Accounting estimates are approximations of future events or amounts, and they are an integral part of financial statements. Common examples include fair value measurements, allowance for doubtful accounts, depreciation, and provisions for contingent liabilities. The challenge is accounting estimates often involve complex assumptions and subjective judgments. Auditors may find it challenging to assess the reasonableness of assumptions and judgments made by management, particularly in situations where the estimation process is intricate. Estimates inherently involve a level of uncertainty as they are based on future events. It becomes difficult for auditors to determine the accuracy of estimates, and there is a risk that the actual outcomes may differ significantly from the estimated amounts. Auditors often need to rely on the expertise and knowledge of management in making accounting estimates. There is a risk that management bias or over-optimism may influence the estimates, and auditors must critically evaluate the reasonableness of management's assumptions. In some cases, historical data may be limited or not representative of future conditions. Auditors may face challenges in assessing the reasonableness of estimates when historical data is scarce, leading to increased uncertainty. Management may face pressure to meet financial targets or present a more favorable financial position. This pressure can lead to management bias or the use of aggressive assumptions in accounting estimates, increasing the risk of material misstatements. Management is responsible for making accounting estimates. Auditors are required to understand the entity and its environment, including the entity's internal control over financial reporting relevant to fair value measurements. Auditors evaluate the design and implementation of controls relevant to fair value measurements. This includes understanding and testing the controls over the initiation, recording, processing, and reporting of fair value measurements. The fair value measurement hierarchy is a framework that categorizes the inputs used in fair value measurements into 3 levels. These levels reflect the reliability and objectivity of the inputs, with level 1 being the most reliable and level 3 being the least reliable. The hierarchy is commonly used in financial reporting to provide transparency about the sources of fair value estimates. Level 1 inputs are observable and unadjusted quoted prices for identical assets or liabilities in active markets. Inputs are based on quoted market prices. The market must be active, meaning there are frequent transactions and prices are readily available. Level 1 measurements are considered the most reliable and objective. Some examples include publicly traded stocks with readily available market prices, exchange-traded funds with transparent pricing, listed bonds with actively traded prices in an active market. Level 2 inputs are inputs other than quoted prices included in Level 1 that are observable for the assets or liability either directly or indirectly. Inputs are based on observable market data, but may not be as direct or precise as Level 1 inputs. Level 2 measurement include items for which there are market-based inputs other than quoted prices. Examples include bonds with prices based on yields of similar securities, derivative instruments with observable inputs such as interest rates or commodity prices, real estate appraisals using observable market data. Level 3 inputs are unobservable inputs for the asset or liability. Inputs are not based on observable market data. They are unobservable and typically reflect the entity's own assumptions. Level 3 measurements involve a higher degree of subjectivity and are considered the least reliable. Examples include valuation of certain complex derivatives with unobservable parameters, fair value of private equity investments or venture capital where market prices are not readily available, determination of the fair value of certain intangible assets based on internal models. The fair value measurement hierarchy follows the principle that if observable inputs are available, they should be given precedence over unobservable inputs. Financial statements are typically required to disclose the level of the fair value hierarchy within which the measurements fall. This provides transparency to financial statement users about the reliability of the fair value estimates. Fair value measurements may move between levels over time. For example, if a previously unobservable input becomes observable, the measurement may shift from level 3 to level 2. The determination of the appropriate level within the hierarchy often involves management judgment and requires consideration of the availability and reliability of market data. Understanding the fair value measurement hierarchy is essential for financial professionals, auditors, and investors to assess the reliability and transparency of fair value estimates reported in financial statements. PCAOB AS 2502 provides guidance to auditors on performing substantive procedures when auditing accounting estimates, including those involving fair value measurements. The standard emphasizes the need for auditors to critically assess management's process for developing accounting estimates and to obtain sufficient appropriate audit evidence. Some examples of substantive procedures include risk assessment. Auditors must assess the risk of material misstatement related to accounting estimates, including fair value. Understanding and identifying the risk associated with accounting estimates guide the auditor in designing appropriate audit procedures. Auditors must evaluate the reasonableness of management's processes for developing accounting estimates, including the methods and assumptions used. Understanding and evaluating the reasonableness of management's process is fundamental to the audit of accounting estimates. Auditors may consider the use of specialists when auditing fair value measurements or other complex estimates. Specialists can provide expertise in areas such as valuation techniques, financial instruments, or industry-specific knowledge. Auditors should test the classification of fair value measurements within a fair value hierarchy. This ensures that fair value measurements are appropriately classified based on the nature and reliability of the inputs. Auditors should validate the appropriateness of valuation models used for fair value measurements. This verifies that the models used by management produce reliable and reasonable fair value estimates. They should also compare fair value measurements to external benchmarks or market indicators. This provides additional evidence about the reasonableness of fair value estimates by comparing them to independent sources. Auditors should evaluate and test the reasonableness of significant assumptions underlying fair value measurements. This assesses the reliability and validity of key inputs used in the fair value estimates. Changes over time should be tested to assess the reasonableness and consistency of fair value measurements, which ensures that changes in fair value are supported by relevant market conditions or changes in the entity's circumstances. Another procedure is to evaluate the adequacy and accuracy of fair value disclosures in the financial statements, which ensures that the disclosures of fair value measurements is in compliance with relevant accounting standards.